We all know that real estate has created more millionaires than any other industry on the planet. We also know that it has created a lot of heartache due to mismanagement, overborrowing, and just simple life events that happen to all of us. Welcome to the Cash Flow Pro podcast. My name is Casey Brown, and I am your fearless leader. And although we might be bourbon sipping and at times foul-mouthed Southerners, we will always do our best to be honest, straightforward, and due diligent with all of the information we pass along to you. Welcome to the show. Hey there, and welcome to today's episode of Cash Flow Pro, your daily real estate investing podcast and YouTube channel. I'm here today with Prashant Satoskar of Catalyst Equity Partners. Prashant, how are you today?
Doing well. Thank you for having me here.
Absolutely, man. We're glad you're with us. I know it's hard sometimes to get time to be with us and share your story, but we're all kind of interested in diving right in and finding out, how you got in the real estate business, where you saw your entrance at, what you were maybe exiting if you had a previous, what I call in this business, a previous life, which I think most of us have of just other things we were doing for entrepreneurial reasons, but led us to be in real estate and real estate syndication. So tell us a little bit about yourself and how you got started.
Absolutely. So I grew up in India. So I came to the US when I was around 22, 23 for my engineering education. So I came here for my grad school, graduated late 90s. That's when the technology boom was picking up. So jumped on that bandwagon and really spent 20 plus years in the technology field. So engineer and technology field, so kind of a recovering technologist, if you may call it, right now. But along the way, I was always interested in real estate. So I was dabbling in it. I bought some single families along the way, starting around 2007-ish. Had a handful of them, a few in Florida, a couple in Dallas. But I did like the cash flow aspect of it. But what I hated was just the management, dealing with tenants,
Yeah. The T's, all the T's, tenants, trash, termites, and so on.
Exactly. And I'm not a handyman kind of a guy, so I can barely change a light bulb in my own house. So when somebody called me for a toilet fix or plumbing, I had no clue how to go about dealing with that stuff. So anyways,
Sure.
so that was really when I started thinking, I wanted to make my life easier. So around 2015, 2016, really, I was thinking, me and my wife were thinking that maybe we should sell all these multiple single families and buy like a sixplex or an eightplex to kind of simplify our problem. We may still have some problems, but at least in one location rather than 10 different locations, right?
Yep.
So as I was exploring that option, I started going to these meetups and, local groups here in Dallas where I live.
Mm-hmm.
And I quickly learned that, I got exposed to this whole concept of large multifamily investing. I had no clue that existed. I didn't know people like you and me could actually buy these large multifamily, complexes. So that was a kind of an eye opener for me. And, I learned about, how people are buying these 60 units and larger complexes, how they're raising money from others to, do this syndication style investing. So that was very intriguing. And I started, first as a passive, invested in one deal to try to explore how that works. And the check started rolling in monthly, quarterly. I said, hey, this is exactly what I was looking for. I like the real estate side of things. I like the cash flow. I don't want to deal with the tenants. So here it is. This is where this is what I was looking for, really.
Sure. Man,
Yeah,
that's definitely where a lot of people get to start and get the bug of saying, "Hey, man, I didn't have to do anything to earn this, or not necessarily didn't have to do anything to earn this, but this is truly passive life, right?"
it is. It is.
And
Yeah.
so, what does this business look like today? How many doors do you all have, or complexes, or however you quantify it? What does that look like?
Yeah. So right now, let me take a step back here. So I started as a passive investor in 2016, did that for a little while. I sold all my single families, invested in 20, 2,000 units or so passively.
Okay.
Then I'm an engineer. I used to be an entrepreneur. So that entrepreneur bug kind of kicked in and said, hey, you know what? The sponsors, whoever are leading this project, I know the numbers. I understand what they're doing. Why don't I do it myself?
There you
So
go.
in
There
20,
you go.
yeah, so 2017, I hooked up with a business partner and started Catalyst Equity Partners back then. So 2017 is when we started and kind of grew the company now to 2,000 units, 300 million plus assets under management, and now we are,
Wow.
lead GPs and doing big deals. So it was
Man. Yeah, shoot, yeah. So are you able, do you have key partners and stuff like that? Now I know some of the bigger deals is what really gets people kind of caught up. When I say bigger deals, I'm talking about like say 10 plus million.
yes,
Where somebody says, I don't know that I would ever qualify for a loan that big. What do you have key partners involved? Do you key partner yourself or key principal? Do you do that yourself or do you have several of those involved?
we do quite a bit ourselves, but sometimes we do get some additional co-GPs to sign on the loans to fill any gaps that we may have. So
Sure,
absolutely,
yeah,
yeah,
yeah. And of course, you don't know those gaps till you get into it and figure out, start dissecting people's income and their net worths and so on. So,
absolutely,
um,
yeah,
what do you have? What do you all have going on right now? Are you are you
yeah.
currently
Sorry, go ahead.
trying to? Are you currently raising? Are you currently trying to take deals down? What do you got going on right now?
Actually, yes, we are actually closing on a deal tomorrow. It's a 288 units Class A asset in Houston. So big deal. Our
Wow.
our biggest deals so far.
Well, what was the purchase price of that?
It was around 65 million.
Dang, what was the equity raise?
It was 28 million.
Oh my gosh, so was some value add stuff?
Yeah, it was a great deal in a great location, a place called Sugarland near
Mm-hmm.
Houston, really good suburb. So first generation, 2004 built, first generation value add. So it's untouched. So we're gonna go in and
Wow.
totally transform the asset.
Yeah, yeah. What when you saw okay, so I want to dive in a little bit here on the value add part of. Let's talk about that specific deal. What I think a lot of people get lost in what the value add part is. Now, it's obvious, pretty easy to say, hey, we're going to add a swimming pool. We're going to value add. We're going to remodel units. We're going to value add. But the other part of the value add, it's kind of a dual meaning we're going to add value to the tenant's life, but we're also going to add value to the property by doing things where we can increase the rent. So, what does the value add proposition look like on that? And then what how did that how does that look on the horizon way out, like say 2 or 3 years down the road?
Yeah, absolutely. So this is, like I said, I mean, built in 2004, untouched. None of the previous owners had done any upgrades to the property. So,
Mm-hmm.
so it's from our perspective, we're going to go in and completely transform this property inside and out. So on the outside, literally, starting with deferred maintenance, like changing the roofs, fixing parking lots and stuff. So that's every property has that. Um, but improving the amenity set. It does have a swimming pool and clubhouse, but we're gonna spruce it up, add some other additional amenities out there to make it more attractive for quality residents to come in, right?
Yeah.
And from true revenue value add, from that standpoint, there's a bunch of stuff we're doing. Standard unit upgrades. The units are really old style brown cabinets. A lot of them still have
Mm-hmm.
carpet, black appliances. So we're going to transform that into a little bit more modern finishes, gray
Okay.
with two-tone paint and quartz countertops, black matte finish. Um, so that in itself, we are projecting a $250 rent bump right on that, interior
What do
value.
you think the cost? What's the cost per unit? What are you estimating the cost per unit on that to be?
It's anywhere from 8,000 to 11,000, depending on the finish we're
Okay.
gonna do. We have two different finishes we're gonna do. So
So if you're looking at a two fifty rent, $250 a month rent bump, and that's $3,000 a year, and it's even at the high end $11,000 to remodel it. It's a pretty damn good return on your money.
Yeah,
I
yeah. I
mean,
mean,
now you're talking almost a 25% return. And of course, some of that's going to depreciate, but 5 or 6 years, you got your money back, and you've got almost a brand new asset at the time. Especially if you start talking about quartz countertops and stuff like that, because that stuff doesn't, that they don't get destroyed like Formica, and you can set hot pans on them and stuff like that. So, wow, that's interesting. Eight to
absolutely.
$11,000 per unit on 288 units.
Yeah, yeah. And if you do the cap rate calculations on that, right? If you multiply 250 per month, multiply it by 288, multiply it by 12, divide that by a 5 cap, you're talking about millions of dollars of, added value to the asset, right? Right there.
Yeah, yeah,
And then
yeah,
yeah,
millions.
yeah.
And you're
So
only talking about, even if you were like, let's say $10,000 a unit, 288 units, $2.8 million, right? 2.88 million, and so you're probably adding 10 or 12 million at the cap rate. What cap rate is it sitting at right now?
we are going in at a 4.5. So that's
Hmm.
super strong for a 2004 asset. So yeah,
Really?
yeah,
Okay.
yeah, yeah.
Okay.
For that
And
particular stuff.
then I'm assuming if you're going in at a 4.5, you're hoping to expand that a little bit, I guess,
Yeah,
as
I mean the market.
as
Yeah, the market cap rate for that submarket right now is high threes. So we just got a better deal. It's an off-market transaction, out-of-state seller. You wanted to get out of there, so we just negotiated a good price, and we are getting it at a
what
higher cap rate than what it should be trading at, right?
how did the off market deal come about?
Relationships. I mean, that's the beauty of this
Broker,
business.
broker.
Broker relationships. Yeah, we've been at it. That's
Wow.
so you stay in the game, build those relationships, and in the end, really that's all that matters in this business, right? Whether it's
Yeah,
broker relationship to get deals or investor relationship to get the money. So it's all a relationship business in the end. So yeah, we've been
that's right.
fortunate. Yeah, we've been fortunate to have build the reputation, and brokers know us, and we get a lot of off market looks at deals now.
Yeah, yeah, and and I'll tell you, those off market looks at deals, because it's always, to me, seems something goes on market, it automatically gets a 10% bump. Not just because of the demand for people looking at them and wanting to make offers on them, but I think the agent really comes in and is like, or the broker comes in. I'm talking about once it goes on the market. It just seems to me like it's always, once you get that pricing guidance and you can really start determining whether or not there's been a lot of homework done on it, and then you kind of go from there. So,
Yeah,
um, I'd like to talk a little bit. I'm glad you're closing this deal tomorrow, because a lot of this stuff is pretty fresh, I guess it seems like, in your mind. But let's talk
yeah.
a little bit about the due diligence, because a lot of people kind of seem to get a little bit lost on the due diligence part, where not lost in what they need to do, but was there any kind of outstanding issues with the property that maybe you had to do special testing on or anything like that to get to figure them out?
No, fortunately, the nice thing about buying these newer deals is there's a lot less of those issues that you're referring to, right? I mean, we
Yeah,
we, we originally started
especially
buying,
Class A stuff.
yeah, Class A stuff, right? We started our careers in 2017 buying C class assets, and that's where the due diligence really came into play, right? You got to look at plumbing issues and roof issues, and a lot of other environmental issues and all that stuff. So not a whole lot here, but we still obviously go through and do, you know, thorough due diligence. We have our in-house construction team now, so walking all the units, getting all the trades in. We still do the plumbing check-in. We still do get on the roofs and make sure, at least understand what the state of the roof is, so we can decide whether we want to replace it or fix it or whatever it is, right? But yeah, I mean, generally speaking, newer deals, it's a lot less of it. We just go through it, and based on that, we create our capex budget, which is what we allocate the funds for, right? So
Sure, sure, sure. And how much? So, all right, 60. You said 65 million,
hmm
right? And you, what was the equity portion of the 65 million? Like what, around 13 or 14, 15 million?
no, it's around. So the total raise was 28. Out of that, 4 million ish was capex budget. So we have about four. Out of that four, I would say 2 million ish is for interiors, half and half. 2 million exterior, 2 million interior, and the
Okay.
rest is all closing cost, down payment and all that other stuff, right?
Yeah. Yeah.
The rate cap cost
Um,
too nowadays, since we are buying bridge, there's rate cap cost involved in that other portion of
um,
the
did
raise.
you all sign on the loan yourselves, or did you have to bring in any
Yeah,
KPs to get that
we
deal
we
done?
we do have one KP who signs on us, but we sign on all our loans. Yeah, for the most part.
Gotcha.
Yes.
Gotcha. Okay. And is it a non-recourse Fannie Freddie kind of deal, or what is it? What is
This
that?
this one is a bridge, non-recourse, and the reason we went that route is it just the business model we have fit the debt, right? So you gotta, whenever you're buying a deal, you gotta match the right debt with the right business plan that you have. So this is a heavy value add. So we expect in the next 24 months or so to boost the NOI significantly, and
Okay.
bridge debt fit well. Gives us easy exit out. No prepayment penalties, and our plan is to kind of refi into
Now,
a.
when you say bridge, explain that just a little bit for the listeners. Tell the listeners exactly what, because most of the time when I discuss bridge, anyway, go ahead and just give us your bridge scenario.
Yeah, so bridge is really a short-term loan. It's a 5-year loan, and the goal there is to bridge the gap between where you're starting off and getting into a long-term fixed debt loan, right? So that's the whole definition of bridge. It's a bridge to some other loan,
Yep.
and people take bridge for two reasons. One, uh, you can get higher leverage, so they kind of they allow you to define the capex cost for the project for you, for the most part, and yeah, and it gives you flexibility. So there's no prepay penalties like you would have with a Fannie or Freddie loan. So it's easy exit. So you can, and typically when you have a plan where you may exit in 24, 36 months, this is a perfect fit for that, right? And
Yeah.
our business plan is exactly that go in 24 months to 30 months, implement our capex, boost the NOI, and then either sell or refi into a more permanent loan. So get cashed out, get our equity pulled out of the deal, or most of the equity pulled out of the deal at the refi event, and just hold the deal longer if we have to.
Yeah. So what that I think catches a lot of people off guard as well. What do you when you plan on that, like what happens if you get to the end of the business plan and everything is remodeled and ready to go, but let's say the market has gone to crap? What is the plan at 5 years if, like, you let's say the property caps the cap rate determines it's worth, say, 10 million under what you paid for it? What's the plan from 5 years forward?
So that's the risk of bridge right there, right? You have to have confidence in the deal you're buying, in your underwriting, and your exit strategy,
Yep.
and your execution ability, right? Because you don't have any option beyond 5. You gotta do something by 5 years. So
Yep.
it's not for everybody, right?
Yep.
For people starting off, it's not recommended you just take a bridge debt when you don't have the experience. But once you're
Yeah.
clear, you've done a few deals, once you know exactly what you're buying, if your underwriting is conservative and you really have confidence in your execution ability, then this option becomes very attractive, right?
Yeah.
But there is
Yeah.
risk, absolutely. I mean,
Well, I think, and one of my, my listeners certainly understand and know that I'm a devil's advocate all the time, every day, all day long. I devil's advocate everything. But my main concern with bridge right now, and I've talked to several of the big guys in the business about this as well, and it seems to be the general consensus. This the terror of the bridge loan right now is the interest rate exposure,
absolutely.
and the interest rate, it comes down, and because that's probably the number one um, cap rate effector, if you will, that there is in the market. Really, I mean that's going to affect your cap rate worse than just about anything. And of course, we all know cap rate determines value, so the interest rate is directly correlated with the value, and I think that's probably the biggest risk right now. And the thing is that it's nothing. There's generally nothing any of us can do about that, right? I mean, you
Yeah.
can obviously, if you can figure out a way to buy it down or something, you can do some things like that. If the upfront expense carries it on, you can carry it out to long term debt. But so 5 years, and I feel like you probably have it in the back of your mind that, hey, 5 years gets here, we can't do anything. We'll refinance the property, we'll hold the property, we'll do something, because they don't just make bridge loans to beginners who could potentially be interest rate averse in 5 years and then bankrupt them, right?
Yeah. No, absolutely.
So,
Yeah, yeah. I mean, there is a risk, and like you said, you're right. I mean, there are mitigation strategies. We are buying a rate cap in this case to um, kind of insulate us from the rising interest rate environment. So what the way we are
mhm,
doing it is we have a 310 spread, what they call over SOFR, but we are buying a 1.8 cap going in. So our interest rate, all in interest rate, is going to be 510, right? For
yeah,
30 months. And the reason we are doing that is we don't want any risk while we are executing our business plan, right? We don't want
hmm
to we don't want to worry about interest rates for the first 30 months. So we just go in, focus on our execution, push the NOI as fast and as hard as we can, and just be ready to, have a capital event at,
Now,
30, 36
what are you, when it comes to remodeling these units? Of
months. Hmm.
course, people can't live in them while they're being remodeled for the most part.
Yeah.
What's what is your what's the strategy for making sure that all of these remodels get done? I mean, are you saying that the residents are, for the most part, are you gonna move residents around within the complex if it gets down to? I mean, that part of the strategy always seems to be a bottleneck for people, because they're like, well, what if I've got somebody that's been there 10 years and they don't want to move and they don't want this or that or the other? What is that? And I know that that's few and far between for the most part, but what your long-term residents that are currently there, what is that looking like?
Yeah, so it is a balancing act between occupancy and upgrade,
Mm-hmm.
velocity, right? So
Yep.
we are shooting for 8 to 10 units, per month, starting month 3, and that
Okay.
that equates to 28 vacant units, 10% of the units. So we may do 7 some months, we may do 10 some months, but we'll have to balance the occupancy, keep it over 90, 90 to 93 range, and still kind of keep doing those upgrades. So, but in general, that's what we shoot for on 8 or so average per month,
Yeah.
keeping the occupancy intact.
And yeah, that's the perfect way to put it, keeping the occupancy intact. Because so what when you get, and it seems to me like keeping the occupancy intact is going to be harder the further down the road you go. Is that generally the idea that hey, once we get 22, 23, 24 months into this deal at our
Yeah,
10
I mean,
units per month, those last 50 units are they people that have been there a while? And if they
Yeah, but
are, what do you do?
no, but if you think about it, at 5% vacancy rate at a 288 unit property, so that's 10 plus units available every month, right? So if you're
Yeah.
95% occupied on a 288 unit property, let's say 300 just for calculation's sake, that's 15 units of vacant units every month available for us to either upgrade or turn, right? So we don't do we may not upgrade all the units that are available because sometimes you got to turn them faster. So we may keep some classic units, for a little while.
Yeah.
But
Yeah.
we have, we should have 8 to 10 units available based on our plan. So
Okay. Hi, this is Casey Brown, host of the Cash Flow Pro podcast and YouTube channel. Have you been thinking about investing in real estate but just don't know where to begin? I'd like to help by inviting you to check out our website at www.3000capital.com. There you will find an array of material that will help you learn all about real estate syndication. And while you're there, be sure to check out our free video series download titled 5 Must-Know Keys to Success in Passive Real Estate Investing. I'd also like to personally thank you for making Cashflow Pro part of your day. Now, back to the show. What is the single biggest expense in this remodel that's going to take place?
So for this specific deal, it's really the unit upgrades, which is going to cost us $2+ million, right?
Well, all right. What's the single?
Single
What's
item?
this? Yeah, what's a single item that's going to be the most? Like,
It's
does any of the HVAC have to be done? I
Yeah,
mean,
so
what is?
so in this case, the roofs for this deal. So these are original roofs from 2004. So that's going to be our
So
base.
yeah,
Yeah,
that's when the 30-year roof really started coming about. And now all of a sudden,
exactly,
we're
exactly.
18 years into that 30-year cycle, and everybody's going, okay, well,
Yeah, yeah. So
so
for this one, we're going to just go in and replace the roof, and that kind of goes well with our full, facelift plan
yeah,
anyways, right? You don't want to have a beautiful color and beautiful landscaping with crappy roof on top, right?
yeah.
So it kind of, we're okay with it, and it needs to be replaced anyways. So
Do you have opportunities for other value add items like maybe covered parking
oh,
or
absolutely.
storage? I mean, do you plan on adding any of that stuff to it, or is it already there?
Yeah, so a few things. So first thing, I mean, there's two technology items that we are adding. So one is Wi-Fi to the whole property. So there's what we call the property-wide Wi-Fi.
Okay.
That's going to be a huge revenue generator, especially for this A-class demographics, right? So we are going to be paying, let's say, $20 to the provider, and we can charge $60 to the tenants. $60
So
is still
yeah, and
cheaper
then
than what they're paying right now.
so it's similar to like a hotel Wi-Fi where you have to put your apartment number in, your last name in, your code in, and then you're on the
Exactly.
Wi-Fi.
Exactly,
Yeah.
exactly. They don't have to sign up anything. As soon as they check in, sign the lease, boom, they get a code. They have Wi-Fi throughout the property. They can be by the pool, have Wi-Fi, walk around the property. I mean, it's super convenient, and residents love it. We've implemented it at a couple of our other properties. So that's one we are doing. We are also implementing, smart locks, smart thermostat technology. So it's an amenity fee that we're going to charge, but it's
Now,
still
is each unit metered separately? So
yes,
each,
yeah,
when somebody comes in and gets
yeah.
electric, then okay.
Yeah,
That's another big.
they get their own electric, so it's individual. Yes, in this case. And then you mentioned,
Um,
patios and stuff. So yeah, we are gonna extend a handful of patios there. We're gonna add some additional. It's already has some covered parking in garages, so we're gonna add some additional covered parking because that's a need. Package lockers is another thing. Like right now, all these Amazon deliveries are sitting in the office, takes up a lot of time from the staff. So we're gonna just implement,
Yeah, package lockers, and I think that's a big thing that's coming for a lot of these places. I really do, and I'll tell you, some of that stuff is like passive income looking in some of these lockers, some of this locker situation.
It is.
And I think that's, I think that's going to kind of be the at least the short term answer for a lot of what's going on in home delivery stuff. So awesome.
Absolutely.
Well, Prashant, thank you so much for your time. I know that you all are busy, and I want to thank you for taking a little time to be with us today. But we've got a couple of questions we ask every guest that comes on the show. They're really easy. There's no big side swipes here. But the first question is, what is the best book that you have recently read or are currently reading?
Best book, Who Not How. So that's a great book that I highly recommend any entrepreneur to read, because that's a dilemma that all of us run into, that we want to do everything and try to solve all the problems in our business, and sometimes it's just better off delegating them to the right people who are good at doing those things. So definitely a good read.
Absolutely. Absolutely. All right. Next question. What is a dream vacation that you have taken or hope to take?
Dream vacation. I do take a lot of vacations with family, but Croatia would be one that I want to, it's on our bucket list.
I think Croatia looks unbelievable. Really.
Just want to check it out. Yeah.
Well,
we like
awesome.
international travel, and that's the next on the list. But
well, it's obvious you are the head of a very competent operator, or you all are very competent operators, and that is generally what a lot of investors look for. Is not necessarily the deal, not necessarily the location, not necessarily all of the numbers, but that somebody is a competent operator, and it seems like you have everything really good and really close together. So if somebody heard something and they want to reach out to you all, maybe invest with you or ask questions, or maybe they want to look into to whatever with you all, what is a good way for somebody to get in touch with you?
Absolutely. So check out our website, www.catequity.com. So that's CATEQUITY.com. Or you can reach out directly to me at Prashant, PRASHANT, at catequity.com.
Awesome. And we'll put all of that in the show notes for all the listeners out there. And speaking of listeners, as always, I ask you to please head down and leave us a 5-star review, type a review so that others may know what you learn, what you like about the Cash Flow Pro podcast. And while you're there, please hit that subscribe button so that you will be notified as we release new episodes. And Prashant, I want to thank you again for your time. Listeners, I want to thank you for your time. I hope everybody has a wonderful rest of the day.
Thanks a lot. Appreciate it.
Cash Flow Pro is hosted by Casey Brown, founder and CEO of 3000 Capital, a commercial real estate investment firm committed to providing its investors with ongoing cash flow and helping them build long-term wealth. If you enjoyed today's podcast, make sure to hit that subscribe button so you'll be notified about all our future episodes. You can find more information about us and our investment philosophy by clicking the link in the show notes below. Thanks for listening.